After last week's central bank guidance and the collective selling of government bonds by major banks, which raised interest rates, the bond market rebounded this week, with the 30-year bond yield hitting a historical high. From what I understand, during another week of intense bond yield competition, banks rejected central bank guidance and were reluctant to sell long-term bonds, resulting in decent short-term market sales. This led to the central bank intervening early last month under the guise of illegal operations to stabilize the bond market, allowing local banks to purchase 10-year bonds and suggesting long-term bond market involvement. However, this did not change market expectations for interest rates. Xu Yong, Deputy Secretary General of the China Banking Regulatory Commission, indicated that the central bank's warning on long-term bond rate risks aims to curb systemic risks from sustained declines in long-term bond yields, establishing the first reasonable range for long-term bonds. However, after the tug-of-war between bulls and bears, market focus still remains on the central bank's attention to long-term interest rate levels. The unilateral decline in long-term bond rates this year stems from imbalances in bond market supply and government debt issuance. With the accelerated issuance of government bonds this year, expectations could reverse with increased supply, leading to rising interest rates. Thus, the reasonable range for long-term bond yields is a dynamic balancing process. Under regulated market conditions, risks will naturally revert to the reasonable ranges after they emerge. However, with the current Fed rate cuts, the impact on the overall market remains weak, and market participants still see short-term government bonds as a tough bet. We need to remind investors that equities and bonds, especially government bonds, favor derivatives leverage. At this stage, the risks are significant, so participation should be cautious. This rational trend, combined with the macro neglect of short-term fluctuations, means that an excessive focus on central bank changes will quickly cool the market sentiment. The factors affecting price changes are complex and significant, making it difficult for individual investors to consistently grasp the constantly evolving market. It is advisable to invest through mixed funds, which would be a better choice.